Hello learners, welcome back. Today we are going to discuss the question on the effects of business transactions. So the question reads, the following opening balances were extracted from the books of Magana traders. We're given items there: furniture 56,000, creditors 20,000, we have bank 11,000, capital 80,000, debtors 25,000, cash 8,000. The question continues. The following transactions took place in the course of the month. 1. Paid a creditor 4,500 Kenyan shillings in cash. 2. Took 3,000 Kenyan shillings from bank for family use. 3. Bought a stock of 18,600 on credit. Then took a bank loan of 170,000. Purchased land worth 82,000 and paid by check. And lastly, received 7,300 from a debtor in cash. So you are asked to prepare Magana Traders balance sheet at the end of June 2016. So when you're given this kind of a question, where do you start? Now, the starting point here is to effect these transactions. So we are going to start with the first one. So we make a list and adjust these balances. And already we have a list here, so it's just a matter of adjusting on the same. So we start with the first one, which read paid a creditor 4,500 in cash. So in this case, which will be the two accounts that will be affected? One, we are seeing creditor. So the creditor has been paid, meaning that the creditor has to reduce. Then cash is another account that has been affected. How? Cash was taken from the business to pay a creditor, meaning cash will reduce. And therefore, on your list up there, where we have creditors, you subtract 4,500, and cash, you also subtract 4,500. Good. So we move on to the next transaction that reads, took 3,000 from bank for family use. From bank for family use. So in this case, the two accounts that will be affected, one, we are saying the bank. And how is this bank account being affected? Money was taken from the bank. Money was taken from the bank, meaning the amount in the bank is going to reduce. So a subtraction. Then family use. Anytime, learner, you see the word family use, personal use, that straight is drawings. Those are drawings. And now, if you remember very well, drawings, when you're being introduced to accounting, you're told that drawings always affects capital account. Drawings always affect capital account. And how do they affect capital account? Drawings reduces capital of the business. Drawings reduces capital of the business. And therefore, where we have a bank, Yeah, on the balances we are given, we are supposed to subtract 3,000. So here we subtract 3,000, and also capital is reducing. Remember our drawings, by also 3,000. Nice. Then go to the next transaction. Bought stock 18,600 on credit. Bought stock. So in this case, our two accounts will be the stock and the creditors. This guy bought stock on credit. So what is happening to stock? It has increased. So we have a new item, that is stock, so an increase, and the creditors of the business also increased. Then business debt is on the increase. So where we have creditors, we add 18,600 plus 18,600, and also we have now a new item known as stock, which is 18,600. 18,600. Next transaction, took a bank loan of 170,000. 170,000. So in this case, we are going to have loan, bank loan, yeah, bank loan, which is on the increase, and also, so because it's a bank loan, we just assume that this amount, actually not assuming, it is the truth, that the bank will deposit this money in the business bank account. Also, the bank is on the increase. The bank account is on the increase. So therefore, we have a new item, loan, which amounted to 170,000. And remember, bank, the amount of money in the bank also increased by 170,000. 170,000. Then next, purchased land worth 82,000 and paid by check. Worth 82,000 and paid by check. Now, the fact that we have a check here, that's a bank account. Yeah. So, money was taken from the bank to pay for land, 82,000, meaning the amount of money in the bank reduces. So, we have to subtract 82,000 from the figure that we have there, the bank figure that we have here. So, continue to subtract 82,000. Next is lard. We add a new item here, lard, 82,000. Yes. And finally, received 7,300 from a debtor in cash. So we have debtors account increasing by 7,300, sorry. So plus 7,300, and cash, sorry, is receiving money from a debtor, sorry. Therefore, debtors is reducing. I'm sorry for that. Reducing. There is a reduction in debtors account. And cash increases. Cash in the business increases, plus 7,300. Yes, now we are halfway. Actually, we are almost through. So what next? What you do next is, where there were effect, you just need to get the balances. So, for instance, creditors 20,000 minus 4,500. Creditors, we have, sorry, this one we recorded, it's supposed to be here, 18,600. 18,600 supposed to be there. I'm sorry for that. Yeah, 18,600. So we have 20,000 minus 4,500 plus 18,600, and this gives us a total of 34,100. 34,100. Then we have bank, 11,000 minus 3,000 plus 170,000 minus 82,000 to give us a total of 96,000. A total of 96,000. Then next is capital, 80,000 minus 3,000. This gives us a total of 77,000. Then we have debtors, which is 25,000 minus 7,300 to give us 17,700. Then we have cash, 8,000 minus 4,500 plus 7,300 to give us a total of 10,800. And therefore, those are the items you need to record on your balance sheet at the end of June. So when recording a balance sheet, don't you forget, always start with the name of the business. And you're told that is Magana Traders. Our business is Magana Traders. So you have Magana Traders. What are we preparing? A balance sheet as at let's see, 30th June 2016. Then you draw a capital T. Draw a capital T. So we are going to use our left hand side for the assets, the left hand side for capital and liabilities. So we get back there. We have our assets. We start with our fixed assets. Yeah, it's good to be orderly. So we start with the fixed assets. Our fixed assets, there we have a lot, which is 82,000. Have column for money there. Can have two columns or one. Either way, it's correct. So 82,000. So the next one is furniture. Furniture is 56,000. And yeah, that is it for our fixed assets. So the total fixed assets is 813 is 138,000. That's it. Then we move on to our current assets. Our current assets, and we have a stock, yeah, whereby our stock is 18,600. Then we have cash, we have bank, we have debtors, we have debtors. Our debtors totaled to 17,700. Then we have our bank. Amount of money in the bank was 96,000. 96,000. And we have cash. By our cash was 10,800. 10,800. So the total current assets we have 14, 20, 17, 6. Just a minute. A total 18,600 plus 17,700 plus 96,000 plus 10,800. So that gives us 143,100. 143,100. We move on. Before moving on, let us total. So we take a total of fixed assets and a total of current assets to give us 100. That gives us 1, 8, and 2. 281,100. Then we move on our right hand side, where we are going to have a record of capital and liabilities. Can start off straight. So our capital is somewhere here, which is 77,000. Yeah, our capital is 77,000. Then we move on to our liabilities, and we have two liabilities. We have a long-term liability, which is our bank loan. Our bank loan was 170,000. Yeah, 170,000. Then we have creditors, which is a short-term liability. If you like it, you can also refer to it as a current liability, which is creditors. Our creditors there is amounting to 34,100. 34,100, and clearly if we total that, will give us I have 100 there. Have us, yeah, we have 1, 8, and 2, and clearly our left hand side and right side, as our debit and our credit side, have balance. So therefore we close our account by double underscoring, and that is how learners you go on, that is how you're supposed to proceed with that kind of a question. Yeah, that question should earn you 10 marks. Bye bye for now, and if you've not subscribed, kindly subscribe. Let's meet in our next question. Bye bye.